the economy is in recession and the interest rate cuts could be coming sooner than you might possibly think. And that's what we're going to go through in this episode. And we're also going to go through the yield curve because plenty of you have been asking about that. So first of all, let's get into the probability of the Fed cutting rates. Why are we talking about the Fed? Because everything revolves around the Fed in the central banking universe. So Canada will likely follow the Fed, even though they pause right now and the Fed is likely to hike another 25 basis points according to this. Regardless of that fact, it doesn't really matter because even though the Bank of Canada has paused, it really makes no difference. They paused, 25, 50 basis points less than the Fed. So anyway, let's get into this. So it's got the different meetings up here, and I've actually linked this in the description for you guys. But you can basically see the May meeting right now. They are predicting another 25 basis point hike for the Fed. But then it starts to get real muddy as we go on into the different contracts here. So if you look at June, they're still going to hold the Fed funds rate the same as May. So basically no more hikes after this next meeting. And then July, you actually see the probabilities start to shift towards a interest rate cut. So that could suggest that something is going to happen this summer because when you look at the probabilities here, it seems like something is going to happen over the summer. So basically, obviously, we know there's a banking crisis going on right now. They haven't fixed the problem. They're not going to fix the problem. They're just basically, trying to glue things together, but they're using PVA glue and it's not working. So if we go to the September contract, that's where you can see that now it looks like they're going to cut rates at that meeting because the target range is actually going to go down. So it looks like at the 20th of September meeting, they're going to cut rates, which kind of goes with what might happen in the monetary system. Because if you listen to Jeff Snyder, he talks a lot about this stuff. Can be very esoteric what he talks about. But in essence, you have these liquidity bottlenecks, one that occur in the spring and the other that occurs in the fall. And that would be lining up perfectly with this cut because then the stock market would likely crash because the stock market actually crashes when they start cutting rates because you have to think, why are they cutting rates? It's likely because of a major issue and something's happened. It's not because everything's rosy because the Fed right now is saying we're going to keep rates at this level and we're going to hold them and we're going to wait until that inflation comes down to 2%, blah, 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 blah. But the reality is people are betting and they're saying that they're not going to do that. So that can mean immense problems in the monetary system. Now, as we get further out, the volumes drop on the contract. So you can see you've got the volumes up here towards the top right-hand side. And then November, another cut at that meeting. So bringing the target range down even more. So that'll be 25 basis points increase from now's Fed funds rate and then a 50 basis point cut by the end of the year. And then if we shift into December, you're talking about possibly holding rates around that level. And then you can't really go into these other contracts because the volume's quite low on them, especially like when we're getting into March next year. And so we don't really know what's going to happen. But essentially, if you look at the rest of these contracts, they're showing that Fed funds rates are going to come down very, 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 very fast. Now, a lot of you have asked about the yield curve, and I keep referring to the yield curve and what it means and how it predicts recessions. And I'm going to actually show you that visually right now because then it's easier for me to explain it. So basically right now, what you've got is an inverted yield curve, and this is very inverted. If you look at 07, and if you look at 2019 before the cerveza sickness, you can see that it is much more inverted than it was back then. Why is that and what does this mean? Well, essentially, it means that large pools of money in the bond market are betting that something bad is going to happen. Something bad is going to happen to cause rates to come down and inflation to come down. And what could that be? Economic crisis, recession, depression, monetary system blow up, whatever it is. But they're predicting that this is going to be very extreme. And that's something of note. So you can see visually on this chart, that it is the spread between essentially the green line here, which is the 2-year yield for the Government of Canada bond. So that's essentially 2-year government debt, and then the 10-year government debt. So right now you've got a massive spread between the two. So essentially, if you hold debt for 10 years, government debt for 10 years, you're going to get paid less interest than if you hold it for 2 years. So that kind of shows that people are very pessimistic about the future, because who is going to buy a 10-year bond at 2.8% if they can get a 2-year at 3.5%, unless they think that there's going to be a massive recession / depression. And when the last time the yield curve was inverted this much was in the late 80s, where you had Black Monday, banking crisis galore, and that's what we're getting into right now by the looks of it. So essentially, that's what it's predicting. And you can see the predictability right here, because if you look at when the yield curve inverted, it inverted in May 2019. It wasn't necessarily predicting that there was going to be a global pandemic. It was just predicting that there was going to be some problems in the global monetary system. And, you know, there were fears over a recession actually before 2020. So, you know, it could have been that likely the global economy was going to head into a recession in 2020 anyways. But then the global pandemic happened, and the fiscal and everything else that went along with that. So if we continue going along here, we'll go to the global financial crisis. You can see that the yield curve inverted in 2007, so a year before the major global financial crisis. And then essentially you can see also here as well, you got the dot-com crisis, and then the data kind of gets a little bit muddy on this chart because that's the end of the data. But you can see in the dot-com crisis, it inverted in 2000. So all of these inversions have come a year before the crisis has unfolded. When did the yield curve invert? It inverted last year in May. So, you know, we're nearly at that year stage where it's likely going to happen this year. And in fact, that's what I'm betting on. I'm actually putting money to work and betting on that happening. I think interest rates will be coming down by the end of the year. I do not think that will be for good reasons. And I think unemployment will be going up massively. So I hope this video kind of provided some insights for you. I mean, really, the yield curve is super, super important to understand. So I would urge you to just go and rewatch this video, because I think it's incredibly important to just understand what that yield curve is. And you can see in the chart that I just showed you, the predictability of that yield curve is there. It is incredibly important, and it's right 99.9% of the time. So it's something to be listened to. Forget the soft landing narrative and forget what they're talking about in the media. So it's absolutely crazy what we're going to see happen. And that doesn't mean, by the way, that we don't see interest rates actually go higher, like they cut them and then they go higher. In fact, that's what I actually think will happen in the long term. They'll go even higher than they are right now. It's going to absolutely crush people, but now we've got the government that has worked out that stimmy checks buy votes. So, I mean, it's a disaster. But anyway, I want to thank you so much for watching. If you've enjoyed this video, you might like that video there. You might also like that video there, and I'll see you in the next one. Take care of yourselves, guys.